Money management strategies for stock trading. Mastering financial discipline for long-term success. Stock trading is an exciting and potentially lucrative endeavor. However, the thrill of the market can quickly turn into frustration or even financial disaster if you don't have a solid money management strategy in place. Many traders, especially those new to the game, focus primarily on picking the right stocks but neglect the equally important aspect of managing their capital effectively. This can lead to impulsive decisions, unnecessary risks, and significant losses. In this video, we will delve into crucial money management strategies that will help you trade with discipline, maximize your profits, and grow your wealth over time. Introduction. The crucial role of money management in stock trading. The world of stock trading is full of potential. The potential to make substantial gains and, unfortunately, the potential to lose significant amounts of money. The problem for many traders is that they enter the market with unrealistic expectations and a lack of proper financial planning. They might get lucky a few times, but without a sound money management strategy, these early gains can quickly be wiped out by a few bad trades. The solution lies in adopting disciplined financial strategies that not only protect your capital but also ensure steady growth. In this video, we will explore how setting realistic profit targets, allocating your capital wisely, and reinvesting your profits can make a significant difference in your trading success. Strategy 1. Set realistic profit targets. One of the first steps in effective money management for stock trading is setting realistic profit targets. It's easy to be lured by stories of traders who doubled their money in a short period, but the reality is that such cases are rare and often involve a high level of risk. Setting achievable profit targets helps you stay grounded and make informed decisions, rather than being swayed by greed or fear. Example 1. Blue chip stock investment. Imagine you've decided to invest in a blue chip stock, a company with a long history of stability and steady growth, like Apple or Johnson & Johnson. These companies typically deliver annual returns in the range of 8–10%. A common mistake is to expect these stocks to suddenly deliver outsized returns, say 50% in a year, just because the market is having a good run. However, a more realistic approach would be to set a profit target of 10–12% for the year. This target aligns with the historical performance of the stock and the overall market environment. By setting this realistic goal, you reduce the pressure to overtrade or take on excessive risk in an attempt to hit an unreasonable target. This disciplined approach allows you to make decisions based on logic and market trends, rather than emotion. Example 2. Trading in volatile tech stocks. Now, consider you are trading in a more volatile sector, such as technology. You purchase shares in a fast-growing tech company that has shown a 20% increase in value over the past month. It's tempting to assume that this trend will continue indefinitely, but markets are unpredictable, and stocks, especially in volatile sectors, can reverse direction quickly. Instead of aiming for an overly ambitious return, set a profit target that's based on recent performance, perhaps 15–20%. If the stock reaches this target, take your profits and avoid the temptation to hold out for an even higher return, which could lead to losses if the stock price falls. By setting and sticking to realistic profit targets, you protect your gains and avoid the common pitfall of letting greed drive your trading decisions. Strategy 2. Allocate capital wisely. Capital allocation is another cornerstone of successful stock trading. How you allocate your funds across different investments can have a significant impact on your overall risk and return. Proper allocation ensures that no single trade or investment can disproportionately affect your entire portfolio. Example 1. Diversification across multiple stocks. Suppose you have $10,000 to invest in the stock market. You might be tempted to put all of your money into one stock that you believe has strong potential. However, this approach carries significant risk. If that stock performs poorly, your entire investment could suffer. A wiser strategy is to spread your investment across 5–10 different stocks in various sectors. For instance, you could allocate $2,000 to a technology company, $2,000 to a healthcare firm, $2,000 to a consumer goods company, and so on. This diversification helps to mitigate risk because a decline in one stock or sector is less likely to have a catastrophic impact on your entire portfolio. It also allows you to take advantage of different market conditions, as various sectors often perform differently in different economic environments. Example 2. Balancing growth and stability. Let's say you're particularly interested in the technology sector due to its high growth potential. You might decide to allocate 30% of your capital to tech stocks because you believe in the sector's future. However, to balance this risk, you allocate the remaining 70% of your capital to more stable sectors such as healthcare, utilities, or consumer staples, which tend to be less volatile. For example, you could invest 20% in a well-established healthcare company that provides steady dividends, 20% in a utility company with a stable cash flow, and 30% in a diversified consumer goods company. This strategy allows you to benefit from the growth potential of the tech sector while having a safety net in the form of more stable investments. If the tech sector experiences a downturn, the stability of the other sectors in your portfolio can help cushion the blow, protecting your overall investment. Strategy 3. Reinvest profits for compounding growth. Reinvesting profits is one of the most powerful strategies for growing your wealth over time. By reinvesting the gains from your trades rather than withdrawing them, you allow your money to work for you and benefit from the compounding effect, where your earnings generate even more earnings. Example 1. Reinvesting trading profits. Imagine you make a 10% profit on a $5,000 trade, earning $500. It might be tempting to take this $500 and treat yourself to something nice, but if your goal is long-term wealth accumulation, a better strategy would be to reinvest this profit back into the market. Let's say you reinvest the full $5,500, your initial $5,000 plus the $500 profit, into a new trade. If this next trade also earns a 10% return, your profit will now be $550 instead of $500. By consistently reinvesting your profits, each successful trade builds upon the last, and over time, this compounding effect can significantly accelerate your portfolio's growth. Example 2. Reinvesting dividends. Consider another scenario where you invest $1,000 in a dividend-paying stock that yields a 5% annual dividend. At the end of the year, you receive a $50 dividend. Instead of taking this $50 as cash, you decide to reinvest it by purchasing more shares of the same stock. Over time, this reinvestment strategy allows you to accumulate more shares without any additional investment on your part. As you accumulate more shares, your future dividends increase, leading to even more shares purchased, creating a snowball effect. After several years, this strategy can result in a significantly larger holding and substantially higher dividend income, all from the power of compounding. Conclusion. The path to sustainable trading success. Successful stock trading is not just about finding the next big winner in the market. It's about managing your money wisely to protect your capital and maximize your returns. By setting realistic profit targets, you ensure that your expectations are aligned with the market's realities, reducing the risk of disappointment and impulsive decisions. Allocating your capital wisely allows you to diversify your risk and balance your portfolio, while reinvesting your profits enables you to harness the power of compounding for long-term growth. In the unpredictable world of stock trading, these money management strategies provide the foundation for sustained success. They help you navigate the market's ups and downs with confidence, knowing that you have a disciplined, well-thought-out plan to guide your decisions. By adopting these strategies, you can improve your chances of achieving your financial goals and building a robust investment portfolio that stands the test of time. 4.0